which of the assets do you believe the standard on impairment of assets will be applicable? We discussed in the previous session that there are only two ways of valuing all the assets, either at cost or either at fair value. Is there any other way? Either all your assets will be measured at cost or either they will be measured at fair value. Now, to which of the asset standards IAS 36 will be applicable?
It will be cost model.
Wherever we are using cost models, IAS 36 impairment of assets will be applicable, because if you are using fair value model, what was the tip we discussed in the previous session?
If we are using the fair value model, then no impairment scope is there then, because we are already taking the value of the, we are already considering a fair value.
I highlighted in the previous session, if you remember, that we either measure it at amortized cost or revalued amount. But if you have anything measured at fair value through P&L or fair value less cost to sell or fair value through OCI, we're required to remeasure it at the end of each year. And if anything is measured at fair value, isn't it automatically taking care of the impairment inherent in it?
Yeah.
Yeah.
It automatically takes care of the impairment inherent in it. So is the reason wherever there is fair value less cost to sell or measured at fair value, the standard on impairment is not applicable to them. The standard on impairment is not applicable to IFRS 5 because there was no cost left. It was fair value less cost to sell and carrying amount being compared now. So IAS 36 is not applicable. In similar fashion, IAS 2 inventories, if you remember, it has to be measured at lower of cost or NRV. Lower of cost or net realizable value. If you look at the standard of impairment, what does the standard of impairment says that it has to be carrying amount compared with recoverable amount. But recoverable amount is value in use and net realizable value. Now what is missing? What is missing? There is no value in use for inventories. The only thing left is net realizable value. So we can directly compare carrying amount, that is cost, with net realizable value. So is the reason the golden principle of inventories is lower of cost or NRV. There is no requirement of testing of impairment because it is being done at the end of each year. Clear? Automatic impairment system inherent in IFRS 5, inherent in IAS 2. So is the reason when you read IAS 36, it will say that not applicable to inventories, not applicable to IFRS 5 non-current asset held for sale, not applicable to investment property measured at fair value model, not applicable to financial assets measured at fair value through P&L. It will say this because wherever we are using fair value, automatically the impairment of those assets is being taken care of. Clear? What is the difference between IAS 16 and IAS 2? These are owner occupied property we plan to consume into the business. But these are assets which we plan to sell in the ordinary course of business. If we plan to sell something in the ordinary course of business, that will form part of inventories. If we plan to sell in the ordinary course of business, they'll form part of our inventories. It doesn't depend on the size. It can be land and building, it can be aeroplanes, it can be anything. Even the land and buildings you can sell in the ordinary course of business. You can sell aeroplanes in the ordinary course of business. So it doesn't matter whether what is the size. So the golden principle of inventory is it has to be recorded at lower of cost or NRV, automatic impairment system. So hope you're getting the point that what is the asset we are dealing with, what is the purpose of owning this asset, and once you know the purpose of owning this asset, its use, the standard follows. If you plan to consume IAS 16, if you plan to sell within 1 year IFRS 5, if you plan to hold it for capital appreciation or for renting it out to others, land and buildings, IAS 40. If it is an intangible asset, IAS 38. If there are indicators of impairment or you need to impair it, you need to follow the principles of IAS 36, compare it with recoverable amount. If you plan to sell it in ordinary course of business, IAS 2. Why would someone get into leases? Like why we enter into leases? What is the reason behind entering into leases? What is the reason? If we are a cash rich entity, we have spare money for buying assets, we'll go out in the market and buy it. What if we do not have enough cash? The other option available to us is renting it out. If we believe that we can only make enough money which will be able to pay rent only, we enter into operating leases. But if we believe that we'll be earning enough, we'll be able to repay the capital money as well as we'll be able to pay interest money as well. So we enter into finance leases. So the concept of operating and finance leases for lessee has gone out, and there is a new term being defined which is known as right of use. Right of use means that if there is a land and building which has a life of 20 years, if someone has entered into a leasing arrangement for 5 years, they have actually bought the right of use for 5 years and they show it as an asset in their financial statements. The right of use is a capitalized asset in the financial statements. It will be depreciated over a period of 5 years. Its value will be derived on the basis of what we are going to pay in terms of direct cost, in terms of present value of minimum lease payments over the life of this asset. What is the total money we are going to pay to get the right to use this asset? That value gets recorded in the balance sheet in the form of leases. We'll discuss it in detail when we are discussing IFRS 16 leases. I'm simply here trying to build up the connection between various kinds of assets which gets recorded in the balance sheet depending on the type of arrangement we get into. IFRS 9 financial instruments guides us on recording of financial assets. I shared with you a little bit of it in the previous session, wherein I discussed about how financial assets are recorded. They are either recorded at amortized cost or either recorded at fair value. If it is solely payments of principal and interest, we record at amortized cost. But if they are debt instruments which intend to sell, fair value through OCI. If we are holding them for trading, fair value through P&L. Now, if the assets which are recorded at amortized cost, to which of them impairment of assets will be applicable? The ones which are at amortized cost or the ones which are at fair value through P&L? To which of them impairment of assets will be applicable?
Amortized cost.
The ones which are at amortized cost comes under the purview of impairment of assets. So though the impairment of assets for financial instruments is taught through the standard IFRS 9 impairment of assets, expected credit loss model. So IAS 36 is not applicable. Expected credit loss model of IFRS 9 financial instruments is applicable on it. So we'll be dealing with financial assets through the standard IFRS 9. So I'll not get into it. So this is a separate standard which guides treatment of financial assets according to its own standard. It has no relationship with IAS 16, 38, 40, 41, IAS 2. IAS 23 is a standard which simply guides it simply provides guidance on capitalization of interest cost into the cost of constructing the asset. Now under IAS 16 property, plant and equipment, you may be self-constructing an asset. If you borrowed funds for constructing this asset, the question arises whether will you include the interest cost as part of cost of making the asset or whether you will treat them as interest expense. This question is answered through IAS 23 borrowing cost, whether interest cost can be capitalized into the cost of making the asset. We'll discuss in detail when we discuss the IAS 23 borrowing cost. IAS 28 investment in associates guides on how to value the investment according to equity model. So they use equity method of accounting for valuing this. In consolidated financial statements, in individual financial statements, it can be at cost or at fair value, depending on what kind of investment it is. In individual financial statements, we can measure it at equity, we can measure it at cost or fair value. In India, we do not allow equity method to be measured for individual financial statements. We'll discuss in detail when we're discussing IAS 28 investment in associates and joint ventures. IAS 41 is the standard on agriculture. IS 41 is the standard on agriculture dealing with biological assets. Biological asset means living animals or plants or agriculture produced at the point of harvest, how to measure them. So this is a separate standard, individual standard, but it has a relationship with IS 16 property, plant and equipment, that if there is a bearer plant, bearer means fruit bearing plant which has life of more than 1 year and it is kind of owner occupied property, owner occupied. So this will be treated as property, plant and equipment to be dealt with under IS 16. This was an amendment after many years. Like earlier, everything biological assets, agriculture produce, living animals or plants were all forming part of IS 41. But there was an amendment that if there are fruit bearing plants or trees which are going to give fruits for a longer period of time, there is a maturity of these trees and there is a maturity of these plants. If they are fruit bearing plants and trees, they should be treated as part of IS 16 property, plant and equipment, and on the basis of maturity period, their depreciation should be decided and they should be consumed into the business over the life of those plants and trees. So this was an amendment for fruit bearing plants. So IS 41 has a relationship with IS 16 property, plant and equipment as well. Hope the relationships of the assets is clear, how they are interrelated. Hello. Will you be able to identify which standard is applicable now? If it is land and building being consumed into the business, 16. If it is land and building held for sale in the ordinary course of business, IS 2 inventories. If it is land and building you plan to sell within 1 year, IFRS 5. If this is land and building which is holding for capital appreciation or renting it out to others, IS 40. If this is land and building you purchased on finance lease, you record it as right of use asset. Clear? So this is how the assets are interrelated. We'll go on a short break and then we'll move on to discuss IS 16 property, plant and equipment.